morning, everyone. Welcome to our tax regulatory update meeting. My name is Jan Wacławek. I'm a tax compliance partner responsible for Poland and CE. And we will be talking together today about two topics. We can use statement hot tax topics, which by definition is a little bit in contradiction. We'll be talking about transfer pricing, new obligations, and it will be led by Monika Laskowska. And we'll be also talking about planned new tax updates in corporate income tax, and this will be led by Marcin. Monika?
Good morning, everybody. My name is Monika Laskowska. I'm transfer pricing partner here based in our PwC Warsaw office.
And I'm Marcin Jaworski, and I'm a senior manager in the tax reporting and advisory team.
So first topic that we'd like to engage you and have a discussion is about transfer pricing and the new documentation requirements that we have from the beginning of this year, 2017. Poland implemented the full package of transfer pricing documentation requirements, which covers local files, master file, and transfer pricing CBCR reporting. This also means that these requirements were implemented into the local domestic regulations. And we'd like to discuss today what are the specific topics and specific provisions that might differentiate Polish regulations from the OECD Action 14 proposal. This means that first of all, with regard to the local files, in Poland we have the regulations that require to prepare the transfer pricing documentation on the basis of every transaction. So it means that in Poland we have a transactional approach. What is specific with regard to the Polish regulations that our law requires the documentation for transaction and other events, other economic phenomena, which is kind of a specific notion that is not defined. We have only examples what can be seen as other event. This is, for example, a cash pool contract. So these are the kind of new requirements that are set into the Polish regulations. Additionally, what might be interested for you that with regard to the requirements, we have kind of significant exemption from the transfer pricing documentation. It covers taxpayers that have revenue and cost around 2 million euros. So basically for the Polish market, it means that around 96% of corporate income tax taxpayers are not obliged to prepare transfer pricing documentation on a local level. Secondly, we have, as I said, with regard to the documentation requirements and transactional approach, we have also the thresholds with regard to the value of a transaction that needs to be documented. And this is the next difference, because as we know from OECD Action 13, the documentation are required for, I would say, the material transactions, while in Poland we have defined version, what does it mean material transactions, and our regulations includes a kind of matrix that indicates the thresholds as the proportion between the revenue of a taxpayer plus the value of a transaction. Secondly, we also have a new requirement obligatory to include within the local file also the benchmark study. This is the obligation for taxpayers that have revenue over 10 million euros. What might be also interesting with regard to the thresholds, that another threshold is set for a master file, which is required for taxpayers with revenue on the consolidated financial statement over 20 million euros. And what is also significant, there are specific regulations for transactions with tax havens and what we call the joint venture agreements. And this means that for transactions with tax havens, we have a threshold around 20,000 euros, and for the joint venture agreements, we have a threshold for 50,000 euros. So as you may see, these are kind of specific and I would say detailed regulations with regard to the transfer pricing documentation. This might create also from some point of view the disputes with regard to what transactions should be aggregated to meet the expectations from the legal point of view to prepare the transfer pricing documentation. Probably from perspective of Board of Management, the crucial point with regard to transfer pricing documentation requirements is the requirement that obligates the Board of Management, the taxpayer, to submit the statement confirming that the transfer pricing documentation was prepared. And what is crucial that this kind of statement needs to be filed with the annual tax return, which at the end of the day means that if not filing this statement, the Board of Management taxpayer is under their personal liability under the penal fiscal code. So it means that thinking about transfer pricing documentation requirements at this point of time, you really need to think about planning and think about how to supervise the preparation of transfer pricing documentation, as well as, of course, before issuing this statement, you need to be aware of what is covered in this documentation and verify the completeness of the whole package. So if we look very generally, what does it mean to have these new requirements in Poland? Probably, first of all, we need to be aware that new requirements increase a workload of the taxpayer as regards the bulk of information that needs to be gathered in the transfer pricing documentation. On the other hand, for the tax authorities and relations with tax authorities, it means that the new requirements increase a lot the level of transparency. This means both with regard to the information gathered with the documentation, but also on the other hand, what is new with our legislation, that tax authorities are requiring also issuing the new tools for transfer pricing risk assessment. By mentioning these new tools of risk assessment, I of course understand the CBCR reporting that is of course prepared by multinational groups on the global level. But what is specific for Poland is the obligation to prepare what we call a local risk assessment tool, CIT TP form. It's a specific form that require to indicate what might be the area of possible tax risk within transfer pricing area. So generally you need to indicate what is the level of particular transactions that are aggregated into specific categories like financial transactions or immaterial services or intangibles. So this is the tool that will be that is implemented but will be used for the first fiscal year 2017, and taking into account the other tools like exchange of information and all the tendency of improving the transparency and exchange of information between tax authorities. This means that the level of information that will be used by the tax authorities increased significantly since 2017. Additionally, thinking about transfer pricing documentation, probably you also need to take into account that due to the new requirements, specifically master file, it is the first time in Poland that probably you need to think about the consistency of the information given in the documentation. As we have the requirement to submit the prepare and submit when on request master file documentation, this is the first time that Polish tax authority will have the access to so-called big picture of the group. And taking this into account, I would say that the profound consciousness should be taken into account when adjusting your local information that will be covered by the local file with the master file. I will elaborate a little bit on this later. What specific does it mean for Polish jurisdiction? But at this point, I will also like to mention that what probably is worth to be raised with regard to transfer pricing documentation is the what we assessed the transfer of burden of proof for taxpayer side. This means that since 2017, generally taxpayers have to prove that they're aligned with the transfer pricing policy with arm's length principle. So, given the pros and cons of these changes, probably the cons are kind of clear, while we also have some advantages with regard to the new regulations. From 2017, we have a higher threshold defining related entities. Finally, our government decided to increase the level of the threshold to indicate the associated companies from 5% to 25% of shares. And of course, taking into account what I said before with regard to the a huge exemption, subject exemption from the transfer pricing documentation requirements, unfortunately, we have a shift of burden for those who are, at the end of the day, obliged to prepare this documentation. So what's specifically new for Poland? What is really the could create the kind of problematic areas with regard to in the phase of preparation of transfer pricing documentation? From your perspective, probably it would be worth to take into account the later decree that was published by the Ministry of Finance that indicates what are the criteria and specific details and information to be included in the transfer pricing documentation. And I'd like to focus your attention on what was regulated for master file. In my opinion, it's kind of, I would say, broadening the scope of what is given in the corporate income tax code. As from the decree, we may see that for master file, the requirement is to include value chain analysis. It is written that the Polish tax authorities expect material significant value chain analysis. But I would like to highlight that this is something that diversified the Polish requirements from the general global one. I don't read the Action 13 in a way that this part is a necessary part of master file, but here in Poland we may see that it become the kind of obligatory part. As I said, for benchmarking studies, we have the obligation to prepare benchmark studies. What is interesting is that there is a preference for local comparables. This means in between lines that our authorities involved with analysis based on looking for local market advantages, and this is something that I would say wasn't indicated in the previous transfer pricing survey made by the tax authorities. By obliging taxpayers to prepare benchmark studies using local comparables, we may expect that there will be more and more discussion on local advantages, taking into account what comes out from the benchmark study. It is also worth to mention that with regard to the local file, the transfer pricing documentation requirements include the information for restructuring. What is interesting, that the restructuring that took place not only in 2017 but also 2016. Preparing the transfer pricing policy and the documentation of local transactions, we also need to take into account how the information given on restructuring issue is aligned with what we show in the master file. We prepare transfer pricing documentation generally for ourselves as a proof in case of tax audit. So it means generally transfer pricing documentation as it's going to be prepared for 31st of March. Doesn't need to be submitted to any local office, so we keep this documentation in our office. But what is specific for Poland, transfer pricing documentation should be revealed to tax authorities on request. And this means that according to the law, we've got only 7 days to reveal, not to prepare, but to reveal this documentation. So taking into account the scope of information that needs to be covered by the documentation, the advice, of course, at this moment is to be prepared and having in mind the statement that I mentioned before. We have to confirm that the transfer pricing documentation is prepared and is complete. So just to conclude the first part of our presentation about transfer pricing documentation, probably it would be worth for you to think at this phase what should be done right now, and of course this is the last moment to assess what is required, what are the specific documentations and what are the specific information required for the local files specifically, but also on the other hand, how they are aligned with the global documentation, with the master file. Generally also need to think about and verify what is available at this moment and what is missing. To prepare transfer pricing documentation in your organization, it is always good to define who does what. As you are entirely aware, due to the new BEPS approach, probably it would be really worth to make a review on who is going to provide the information and what kind of information to prove the policy with regard to the substance of your economic activity in a particular jurisdiction, and what kind of documents you'd like to use to protect your established transfer pricing policy. Of course, the question, when should I do it as quick as possible? That's the first answer to this. But generally, as my observation is that the bulk of work is focused on aggregating data and aggregating the information that will need to be submitted as a on request as transfer pricing documentation obligation. I think it's also good to know that as a local file needs to be updated on an annual basis, for benchmark studies, our regulations indicate that the update might be done for at least 3 years. So generally, it is expected that benchmark studies can be done every 3 years. So at this point, I think I presented the all necessary information about transfer pricing documentation, indicating the significant difference that we have taking into account our domestic law in comparison to the global one.
Okay, thank you, Monica. I would like to remind everyone that we are here, and Monica will stay with us for another half an hour when Martin will be presenting the update about corporate income tax changes. So if you have any questions, please use chat. We are trying to answer all your questions in the meantime. Martin?
Okay. So I'll be presenting the revolutionary, I do not hesitate to say, changes in the Polish corporate income tax, which are generally driven by the very, very fiscal approach of the Polish financial authorities. And most of the changes that are actually happening daily, the most recent changes to the proposed draft happened 2 days ago, and they were really major changes to this draft, which I will discuss later on. All these changes are driven by the anti-tax avoidance directive. They are driven by the perception of the Ministry of Finance that there has been huge tax leakage in Poland, that multinational companies especially have not been paying enough corporate tax in Poland, that there have been a lot of different structures used to limit corporate income tax obligations in Poland. So all of the changes that I'm going to very briefly present today are driven by the Ministry of Finance's approach to close corporate income tax leakage. And the changes for them, the plan for the changes is that they start functioning from the beginning of 2018. So according to the Polish legislative practice, they should be published and enforceable by the end of November this year. So as you can see, there's not much time left to finalize these changes, whereas they are at the very early stage of the legislative process in Poland right now. They have been introduced into the Polish Parliament, and there has been a first reading of these changes. However, there are still, as I mentioned, there are still some amendments done. There are still some final touch-ups or changes made to these proposed drafts, and they are generally what we will be discussing today is 4 main aspects, which I think have the most impact on the multinational businesses operating in Poland, and some other minor or more minor changes, which could also, in our view, be potentially significant. What is I think important right now to remember is that these changes right now are still evolving. This is not a final shape of the draft. We can expect different outcomes or different amendments basically any day. So what we are discussing right now is very fresh. It's basically 1 or 2 days old in terms of the changes that we have. Okay, so the key points which we'll be discussing is the limitation of deductibility of intangible services costs, is the limitation of corporate income tax deductibility of financing costs. It's the introduction of basketing of revenues in Poland. We have up till now we have not had a separate capital gains taxation and separate business profits or other operations taxation, and this will be introduced from the 1st of January 2018. Plus, there is also a very interesting and controversial idea of levying additional corporate taxation, or levying, let's say, minimum corporate taxation on real estate holdings or on entities holding real estate and obtaining revenues and potentially profits from this real estate. So these are the key items that I will discuss. Also, during the course of this part of the presentation, we will also, as PwC, have a couple questions to you as participants, which I think can also show to all of you participating in this event to what extent you feel you will be affected by these changes. It's our estimation, and it's our also knowledge from the discussions we have had so far, that a lot of entities will be very much affected by these changes, but I think it will also be helpful for you right now to see as what it looks like within your group as participants in this webinar. So going smoothly and quickly to the changes that are key from our perspective and our experience. The introduction of revenue baskets is driven by the fact that the perception of the Ministry of Finance is such that capital operations, sales of shares, mergers, acquisitions, spin-offs, and other in-kind contributions, etc., generally all capital-related operations, but also operations related to intangible assets, such as royalties, know-how, trademarks, etc., were used by taxpayers in Poland to offset or to artificially create losses and offset the profits generated by the entities from usual business operations. So basically, what will happen, and this is area that has not been really changed much throughout the course of the legislative process, which started in July. We will have a capital gains basket, we will have an other business operations basket, and costs and revenues from these two baskets will not be combined. I understand this is not a foreign concept to many of our foreign participants, but in Poland this is something completely new in terms of corporate income taxation. It has already been present in personal income taxation, but this is a complete novelty for corporate income tax. What we have already, or what we understand from the discussions we've had so far, there is no clarity in terms of what types of costs will be allocated or should be allocated to a particular revenue basket, whether it's only directly related costs, to which extent indirectly related costs should be allocated to a given revenue basket. This is not clear. We think it will be subject to subsequent interpretation, and the precise guidelines we feel will evolve during the following years and the tax authorities and taxpayers' practice. So this is an area where we feel there could be some discussions or some doubts. In terms of what is understood as capital gains basket or capital gains taxation, as you can see on the slide, this is basically proceeds from dividends, sales of shares, sales of receivables. However, only those receivables that are not related to operational activity. During the previous stages of the process, the approach of the Ministry of Finance was such that all receivables, regardless of where do they stem from, should be treated as capital gains revenues. This has been corrected. The ministry has withdrawn from this position, and we feel that's a reasonable step by the ministry. Other items, liquidation of companies and proceeds from that, redemption of shares, mergers, divisions, in-kind contributions, etc. There are, I think, two particularities about the Polish capital gains perception. One is that, unlike in some more mature jurisdictions, sales, proceeds, revenues from real estate operations are not, as of now, deemed to be located in the capital gains basket. However, all revenue from selected types of intangibles like licenses, know-how, copyrights, etc., this all is perceived by the ministry as capital gains, and this is the wording of the regulations so far. So it's affecting, in particular, businesses which take a lot of their revenues from core business operations which are related to licensing, like for instance some media entities we feel could be affected by this, because their core business would in fact be treated as capital gains. At the slide you also have an example of a very simplified example, of course, of the way the taxation will look like from 2018, but the basic principle is the way as I mentioned. So you will have a separate basket of capital gains. If you have losses in this basket, you can offset them and utilize them with profits only from this basket, and you cannot mix the profits and losses from the two different baskets. The question that often arises is what will happen with the losses that I have accumulated so far. Should I perhaps retrace my steps and calculate where these losses stem from, or to be able to allocate them to different baskets? This was not clear previously. Recently, some intertemporal regulations were introduced, and the position right now is that in terms of past losses, the division between baskets will be suspended, so you will be able to deduct your past tax losses from your general corporate income tax result. So this is I think in very brief terms the idea of basketing revenues. The second point, which is highly controversial and is, I think, the one that is subject to most changes, in particular 2 days ago, is the limitation of tax deductibility of costs of intangible services. In this case, intangible services are understood as advisory, management, data processing, marketing, insurance, guarantees, services, but also again, license payments, so royalties and trademarks, know-how, etc., etc. But also transferring risk connected with bad loan receivables through insurance derivatives, guarantees, etc. So the concept of intangible services for the purpose of this regulation is very broad. The idea behind this regulation is that the ministry's perception is that the multinational entities in Poland have been extracting a lot of revenue from Poland based on management fees and similar transactions, and the government has performed some internal analysis which said that the growth of management fees in Poland has been disproportional to the growth of the general Polish economy, and that's why they decided to act against it. That's why there will be a limit on tax deductibility of these types of costs introduced. The limit will be calculated as a percentage of EBITDA, but a percentage of tax EBITDA, which is again a new concept in Polish legislation. Again, I understand this is not a new concept in some more mature jurisdictions. However, what you should remember is that Polish tax result and the tax EBITDA will be much different from your accounting result and accounting EBITDA, due to the fact that that Poland is one of the countries where the differences between the tax and accounting result are the biggest. There are, in order to arrive at your corporate income tax result, you have to make a lot of adjustments, and this is a very specific case for Poland. The general principle of calculating the EBITDA is revenue minus interest and minus costs lowered by depreciation, amortization, and interest costs. So the principle is rather easily understood and simple. And if the cost of intangible services as defined before exceeds 5% of EBITDA calculated as such, then this limit is constitutes non-deductible costs. There are a lot of exclusions, fortunately, from this limit. When the draft was first introduced in July, it was very broad and basically indicated all intangible services will be limited, regardless of who's the provider, regardless of their type. There were no exceptions. Right now, and this is the area where a lot of changes are being made. There are exclusions, first of all, for transactions with unrelated parties. There are restrictions. There's an exclusion for transaction within tax groups. There's an exclusion for accounting, legal, and recruitment services, which was recognized that because it was recognized that introducing such a broad limit for intangible services is basically limiting the existence of shared service centers, for example. So these are some of the exclusions. The newest exclusions are that transactions covered by advanced pricing agreements will also be excluded from this limit. Further exclusions are are costs which are re-invoiced by a taxpayer will also not be subject to this limit, plus costs directly related to production of goods and services, so basically costs which constitute a cost of producing goods, rendering services directly. They will also not be subject to this limit. Of course, the question is who is to define what it means that certain costs or services are directly related to a given type of revenue, to a given service or cost. There has been an ongoing discussion for many years in Poland regarding timing of recognition of costs in corporate income taxation. What does it mean that a cost is directly related to revenue, and what it means that a cost is not directly related to revenue, and this is not clear even now. So we feel there will be a lot of discussion around this point as well. The final exclusion is that insurance and guarantees provided by financial institutions will also not fall within the scope of intangible services as understood by this particular or as presented by this particular regulation. Okay. What's more, also intangible services related to the value, initial tax value of fixed assets will also be excluded. Okay, and the final thing is that if your intangible services costs exceed the limit of deductibility, which is 5% of EBITDA. However, there is also a safe harbor introduced, meaning that if your intangible services are below 3 million zlotys, they are deductible in full. Nevertheless, all costs above this 3 million safe harbor are subject to the limit. But if your costs exceed the limit, you can include them in and deduct them within the limit that you calculate for the following 5 years. So that's basically the idea. Okay, and now there is a question to our participants regarding the impact that you feel the new rules on tax deductibility of intangible services, of royalties, might have on your tax position in Poland. And we have 4 proposed answers to these questions. I think they are pretty self-explanatory. As soon as a lot of you, or a significant part of you, complete this survey, we will present the results to you. But until that happens, I think it will be beneficial to discuss a question that I have here in front of me from the chat. This is actually a very tricky and difficult question regarding the relation between intangible services limitation and the basketing of revenues. This has also been thought of by the government only recently, that there is there could be such a relation, and what the taxpayers should do with it. So basically, the idea is that first of all, you will have to calculate your revenue according to baskets, and you will have to allocate your intangible services costs to different baskets. Then subsequently, you will calculate your tax EBITDA regardless of the baskets. When you arrive at the limit of deductibility, and you see that there is a portion of intangible services costs which cannot be deducted, then you should allocate this limit proportionally between baskets in line with the proportion of intangible costs that you allocated to these baskets at the very beginning. So this is a rather complex process. Okay, what I think we can show the results right now of the survey. Okay, so as you can see, the results are pretty evenly split. Luckily, the highest proportion of you indicated that these changes will have no impact for you, which is I think good news, because these changes, they are, as I mentioned, they are difficult to understand, they are difficult to calculate, but if they will not impact some of you, then it's positive news. However, in general, either slightly or significantly, majority of you will be affected. Okay, so having discussed this area, we have another proposal from the Ministry of Finance to limit another type of costs, and this is the limitation of costs of financing, limitation of costs of interest, where the principle will be very similar, only the percentage will be a little bit different. What you should remember here is that the definition of financing costs is very broad in Poland. Basically all banking fees, not only interest, are included in this definition. The limitation is constructed in a very similar manner to the limitation concerning intangible services. So basically, if your interest financing, and regardless of the source, so whether it's from related parties or unrelated parties, if it exceeds 30% of tax EBITDA, it's non-deductible. The safe harbor is again 3 million zlotys. There are some entities excluded from this regulation, mainly financial institutions, and also one provision that the government has decided to introduce as an intertemporal regulation is that until the end of 2018, loans which were granted before the start of 2018, they can be treated for thin capitalization purposes as they were until the end of 2017. So this change is in its mechanics, it's rather similar to the change regarding intangible services. I think the final key point that we should discuss and we should bring to your attention is the one that doesn't perhaps affect all of you, but is affecting the general investment sentiment in Poland and is affecting the Polish real estate sector. This is a minimum corporate income tax on commercial properties, and it stipulates that if you own commercial property which is worth more than 10 million zlotys, you should pay monthly a percentage of its value as a corporate income tax. However, if you pay as an entity, if you pay more than this percentage. If you pay a higher amount of corporate income tax every month, then you should not pay. You may deduct this obligation from your general corporate income tax obligation. So basically, you won't be paying this tax if you're paying some corporate income tax. If you're paying a given amount of corporate income tax, which the ministry deems reasonable, then you won't be paying this minimum corporate income tax. However, this tax is what I think what you should remember is that this tax is not related to profit. It's only related to the value of the commercial property that you hold. So in that case, owners of shopping centers, department stores, standalone shops, boutiques, and office buildings, they will be paying this minimum tax. And I think now it's a good time to introduce the second question, which is from these changes that I have presented very briefly to you, because these are major changes with a lot of regulations, and there's a lot of work to do to comb through these regulations. Which of these do you feel will affect you the most? I think it's an interesting question. It can show you the general market sentiment or the general market approach to these changes in Poland. While you're answering these questions, I will briefly move over to some further amendments, which are also generally driven by the ministry's approach to eliminate tax leakage, which are driven by the identification of the ministry of certain structures which, in their view, limited corporate income tax payments in Poland. And these changes are basically regarding tax groupings. We have had around 170 tax groups in Poland registered. However, a significant proportion of them have not moved or have not finished their first corporate income tax year. So the ministry's perception is that they were used as vehicles for some tax optimization. That's why these changes in terms of tax groupings are aimed first and foremost at limiting the misuse of these groups, and on the one hand. However, on the other hand, they also aimed at making and joining these groups more flexible and easier for the taxpayers. Okay, so okay, I think we can discuss it in more detail. Basically, what happens is that the tax group it will be possible for the tax group to have a lower level of profitability. It will be easier to join the tax group in terms of capital requirements. The threshold will be lowered from 95% to 75%. This should be easier for the taxpayers on the one hand. On the other hand, if in some manner or fashion tax group fails to meet these criteria, the change is that basically what will happen is you will have to calculate back your taxes for the period during which the tax group operated. Right now, when the tax group ceases to exist, nothing happens in the past. However, when the tax group will cease to exist in the future, it will have to either calculate back the tax or it will not enjoy any other benefits. Okay, I think right now we have the results of the survey, and I think we can publish them and we can see them. Okay. In terms of other changes that will be introduced from 2018, What I think is worthwhile to remember is that on the one hand, the scope of CFC rules in Poland is narrowed because it will affect only entities in which the Polish entities have 50% of shareholding. On the other hand, however, the ratio of passive income in these entities will be lowered. So it depends on the particular situation of a given entity and a given group, whether there will be more or whether there will be fewer entities subject to Polish CFC regulations. Other changes, which I will only indicate very briefly, is that interest from debt pushdown structures, deductibility of this interest will be explicitly excluded in the Polish regulations starting from 2018 in the shape that they are in right now. Costs in sale and leaseback transactions will also be limited to the amount of revenue previously recognized. So as you can see, the ministry has identified these two structures as perhaps giving an undue tax advantage to taxpayers, and is trying to limit the effectiveness of these structures. However, as a benefit to the taxpayer, ministry has also decided to be very friendly and allow the taxpayers to write off costs of fixed assets which are of a value below 10,000 zlotys in form of a one-off write-down. Previously, the limit was 3,500 zlotys. So, and I think we are very briefly or very close to finishing this part of the webinar as well as the whole webinar. So I think if you have any questions that haven't been answered during the chat, we will please do not hesitate to contact us, and I think I'll give the voice over to Jan for a wrap up right now.
So thank you all of you that we can't see on the other side of camera. I hope you found these two topics very interesting. So as Marcin said, if you are if you would like to have any follow-up discussions, please contact your PwC contact or either of us. I would like also to thank Marcin and Monica, or Monica and Marcin, because they made my job today very, very easy. For those of you who would like to record or share what you have heard, we will be sharing video of this event together with slides, so those will be available. And I hope you found it interesting. This is in fact first our English webinar, and I hope we should continue. So I propose that next time we'll be talking about VAT, and another hot topic is split payment, and safety development, which is also a quite interesting topic. So we would like to wish you a good day, and talking to you soon.
Thank you.
Thank you.